It's the last day of the earnings season, so as the season draws to a close today, Rakesh Arora, Head of Research at Macquarie Cap Securities, joins in now to make sense of the quarter gone by. Hi Rakesh, first before we talk about individual stocks etc., what's your final assessment of how earnings season has panned out this time around?
Yeah, we're yet to do detailed analysis because results are still coming out. But one gets a feeling that it was a mixed bag, results, and also possibly, a reflection of where the economy was, and not where the economy is headed to. So clearly, the defensive companies did very well, and cyclical companies were found wanting, which was not really surprising. So suddenly, we are finding that market is giving too much of emphasis on these results, whereas the economy is changing for better, and the next 12 months to 24 months the story will be totally different. So from that perspective, I would say that good chance to accumulate some of the cyclical sector and stocks in this results where there's been a little bit of disappointment.
Fair point. You put it nicely when you say the earnings reflected where the economy was and not where it will be. But therefore, where would you place your bets? Let's start with semi-cyclicals, which actually did well. The automobile space, most of them did reasonably well. Would you go ahead and continue to accumulate these?
Okay, so there was a clear divergence within the auto space, with two-wheelers not doing that great because there's very high competition intensity, and companies were not able to pass on the cost increases, thereby losing margins. So two-wheelers is a space which one would like to avoid, but four-wheelers is a different story altogether. And I think demographic shift is also prompting one to look at four-wheelers more closely. So I would tend to, buy all these four-wheeler companies like Maruti, Mahindra, Tata Motors. So these are, better placed as compared to two-wheelers in this space.
Let's take that cyclical which behaved like a cyclical and did badly, Larsen & Toubro. Your analysis of the stock, its future performance, and your call.
Yeah, see, there was a miss of 1 or 2%, which doesn't really matter much because it was a cleanup act by the management, where they wrote off some of their slow-moving items, mostly in hydrocarbon space. And I think the company is on a clear slate for future growth coming in. We believe that L&T is well poised to gain in this environment where its competitors have been have either shrunk in size or are not even have balance sheets to really bid for good projects. So L&T would benefit from survivor's bias and would be able to get projects at a much better margins, etc. in future. Stock has corrected quite decently, from highs of 1700 plus to now 1400. Downside probably 5-10%, but upside could be huge. So L&T does remain our favorite pick, and I don't think if you believe in India story, you can avoid holding on to L&T. So no real doubts on L&T's performance going forward.
Okay, I was actually very interested to see the changes that you've made in your top 10 list of your portfolio, Rakesh. You have added Reliance and you've replaced Idea. I thought it would be the other way around, given that Idea's numbers were so good. But what's your rationale there?
So clearly, we wanted to keep an exposure to telecom space, and Idea is one of the best companies to own in that area. But off late there have been a lot of concerns on growing competition, and most probably from Reliance entry into telecom space. So we thought that the telecom or the Idea's fortunes are linked to the way Reliance Jio really performs. And we are getting this whole exposure to telecom at almost zero cost, because the company Reliance has already invested around $8 billion into this space, and none of the analysts are giving any value for that. So you're getting the telecom exposure kind of free, plus Reliance is coming to an end of its large capex. Probably by end of 2015 onward, you will start seeing that in numbers. And also it gives you a decent play on phasing out of subsidies in the energy space. So So all these things put together, we thought that, Reliance does seem a better play, both on telecom, energy and, government reform. So, that was the logic behind this shift.
Okay. What about the metal stocks? Yesterday we had a great number from NALCO, a mixed performance from Tata Steel, but still eye-popping as far as its foreign performance was concerned. Hindalco due today. Metals were the flavor of the season globally.
Yeah, see, metal stocks have done reasonably well, and I was just looking at the steel companies' results. Meaning Tata Steel has met numbers, SAIL has missed a little bit. Both JSW and JSPL have, beaten consensus estimate. So steel, largely companies have done, quite well. And same is true for the base metal companies, and all this is because of the rally that we've seen in the base metals in the last 3-4 months. But going forward, I think they are, one, the stocks have already moved up quite a bit. So one has to be a little bit selective in this space. Number two is that there is huge oversupply in most of these metals. So unlikely that commodity prices can move back to the highs that we saw in 2006-07. So clearly the upside on commodity prices is limited. And, it will all depend on what government action does, happen on this front. Remember that finance minister has already spoken about increasing royalty rates. So that would be one of the key negative catalysts for these companies. Secondly, some of these guys are stuck with their mines either closed or waiting for some approval to restart. So that is also going to be a big factor, especially for guys who are in Odisha. So I would say that at this juncture, most of these stocks are looking more neutralish rather than in a buy territory. Two stocks that we really like, which we think are looking value. One is Jindal Steel and Power, which hasn't really done anything till now, but now results are surprising on the higher side. And along with Jindal Steel and Power, I think Sesa Sterlite is the other one which merits attention. Okay. So these two stocks are looking really decent, and investors can look at current levels. Others, I would say, wait and watch and, buy on dips whenever there's any negative news flow out there.
Okay, so let's talk about two stocks that you've added weight on to. One is Glenmark and the other is HCL Tech. I understand the rationale behind Glenmark, but for HCL Tech, wouldn't you be worried about, the constant currency growth slipping, the slightly subpar dollar revenue growth, etc., that they reported this quarter?
So basically, since Indian rupee has kind of stabilized at around 60-61, and post-election there was a lot of expectation that rupee might head to 55-56. So now those kind of worries are out of window, and with possibility of a interest rate hike in US by first quarter, we think that rupee might stabilize at these levels only. So in that context, we had to cut our underweight on IT and pharma, and so these are the two of our top picks in this space, and more mid-cap in nature than large cap. So to while we are underweight, to add a little bit of beta to it so that we don't miss out if there's a rally in defenses. So it's kind of balancing act out there, but remember that India's story is the one which will play out over the next 2 years, and that is where our big overweights are: financials, industrials, and we are still underweight on IT and pharma.
Fair point. What about mid-caps, actually, since you even referred to them? What are the choice mid-caps? Let's start with first this Adani Ports Lanco thingy. Anything in the infra space at all that you like?
So infra, apart from L&T, our top picks is, Crompton Greaves, Cummins, Adani Ports, Gujarat Pipavav Port, CESC. So we like a lot of companies in this space, and most of these have individual catalysts also for individual stocks. So investors can look at all these names. The only point we are making is that some of the companies which are very highly leveraged might not be able to come out of this, because even if they dilute by say 1,000% or sell their assets, they may not be able to recover the debt on the books. So clearly, one has to differentiate. The past, leaders in this space may not be able to probably continue. There might be new leaders which will be found in this space this time around.
You track Walkart as well closely. I mean, your house does. What's the call there after the disappointing numbers that it posted? Is it a good time to buy into the dip, or would you stay away?
At the moment, I would say that it's not really right time for investors to look at Walkart. There is a possibility of further action on the FDA part. So I would, wait for some clarity, meaning if one of its plants get reapproved by FDA, that would be the really time to look at Walkart. Till that time, I think it is kind of wait and watch on that name, meaning I won't really, start buying at this time right now.
Okay, Rakesh, finally, the other mid-caps which we often don't pay much attention to because our conversation normally is collared by the big guys, say a Jain Irrigation, a Whirlpool, a whole host of stocks have done well, yet mid-caps as a lot are under the weather. What would you pick when the going is still attractive?
So basically, I would say that, mid-cap had run up quite a bit well ahead of fundamentals, and they had gone well beyond the historical averages as compared to large caps. So we are seeing a healthy correction coming in mid cap, and I think it will take some more time before mid caps really settle down. But our pick of mid caps in industrials, as I told you, GP, PV and CESC is two mid caps we are pushing. Then in media we are pushing Dish TV. Then in pharma we are pushing Glenmark and Strides. IT, HCL Tech is no more a mid cap, but kind of HCL Tech. So we have a host of companies that we are pushing in this space, but little bit selective and not really broad brush.
Fair point. Thank you very much for that exhaustive analysis of mid caps and large caps, Rakesh, and of the earnings season that concludes today.